Why do some lenders offer debt consolidation loans? Why do they offer money to people who are already in debt? What do they have to gain? Well, the most obvious first reason is that they will earn the interest expense on the loan. If a borrower is making their loan payments right now, they would love for you to be making them to them instead of somebody else. After all, the primary way lenders profit is by charging interest on their loans. Even if a new interest rate is lower than the borrower's old higher interest debts, it's new revenue to them. They can also make money on other fees as well. The most common one is an origination fee. Now, not all lenders charge an origination fee, but those that do will charge between 1% and 12%. Generally speaking, origination fees that are above 8% are getting to be pretty high. Of course, origination fees are accounted for in the loan's APR. So a loan with a low APR and a high origination fee is still a low-cost loan. But you don't get a reimbursement on the origination fee if you pay the loan off early. So if you know you want to pay the loan off early, you will want a lower origination fee. But what about credit cards that offer 0% interest for an introductory period if you transfer the balance? At least for a while, the borrowers won't be paying interest. How are they profiting then? For the introductory period, the borrower is almost borrowing money for free. Almost. All balance transfer offers come with a nominal balance transfer fee, like 3% of the transferred amount. But that 3% probably isn't enough for the companies to cover its costs, much less provide a profit. What's more, the best balance transfer offers extend that 0% APR promotion to new purchases. And that is the secret to understanding why they offer the promotion in the first place. While they won't make interest on the balance on the card, they will still make the interchange fees that the merchant pays when you use the card. When the credit card companies offer 0% interest on balance transfers, they are making two long-term bets. The first one is that you will still be holding a balance after the introductory period ends, so they will start earning interest at that point. And the second bet is that you will use the card for a long time, even after you're out of debt. So this is how these companies make money. But there is another side to lending that these companies worry about, and that's losses. They are very focused on trying to identify people who will successfully pay the money back. They want to weed out anyone who would be at risk of defaulting on the loan. Debt consolidation is a great way to find people who are currently making their payments successfully. If the lender then gives the customer a lower interest rate and lowers their monthly payment, they are even less likely to struggle to repay the loan. This is a great way of identifying the borrowers who are most likely to make their payments. While it is possible for the previous lender to restructure the loan term in order to keep the borrower from taking someone else's debt consolidation offer, it's actually not common. They are currently making money from you. To ask them to make less money on you simply because you asked them to lower the interest rate, that doesn't make sense to them. So debt consolidation makes sense for the companies. The question is whether it makes sense for you. If done correctly, debt consolidation can be a great tool to help a borrower get out of debt. There are three considerations that a borrower should think about before deciding whether debt consolidation is right for their situation. First, can they get a lower interest rate? We recommend that you only consolidate your debt if you can get an APR that is 2 to 3 percentage points lower than the interest rate on your current debts. This will ensure that consolidating is financially worthwhile. Second, will consolidating make it easier for you to make your current payments? When you consolidate credit card balances into a personal loan, you will usually drop your current monthly payment. So if you're struggling to fit your current monthly payment into your monthly budget, debt consolidation could help. Third, do you have the necessary discipline? If you struggle to have the discipline to make extra principal payments on your credit cards, or you run up new balances as you pay them down, debt consolidation could solve those problems for you. After you consolidate, you need to cancel your credit cards. You should no longer have the ability to charge up new balances. The good thing about a debt consolidation personal loan is that you have a set payment amount and a set term length on the debt. If you just make your payments, you will get out of debt. If you want to see whether a credit card debt consolidation loan could work for you, you need to make sure you shop around. Getting the lowest possible interest rate can save you thousands of dollars. At the Yukon project, we've tried to make shopping around easy. If you visit our lending marketplace page, you can select credit card or debt consolidation loan as the purpose of your loan, the amount that you need, and your approximate credit score range. When you apply to any one of our featured lenders, we will check your rate with up to 40 other lenders behind the scenes. Our partners use a soft credit check, so applying won't hurt your credit score. We will show you all of your approved offers so you can be sure you're getting the lowest APR that you can qualify for in your situation. Debt consolidation can be an effective tool to help you get out of debt. There are a lot of lenders out there who offer specific features to entice borrowers to consolidate with them. These national banks and these personal loan lenders will all pay off your other creditors for you when you consolidate with them. That's awfully convenient, but it also shows that they know that the new debt won't stack on top of your old debts. Because the new loan won't increase your debt to income ratio, it should make it easier to get approved by them. These credit cards are currently offering an introductory period of 0% APR for credit card balance transfers. These deals change frequently though, so double check if they are still offering the promotion before you apply. You can check our website if you want to look at their recent promotions. These offers could be a great way to save on interest expense, but credit cards come with the added risk that you don't completely get rid of the debt. Credit cards are designed to make you pay minimal monthly payments. They are not designed to automatically get you out of debt. Of course, you know your situation and can make the decision that would be best for you. The goal is to get out of debt and stay out of debt. You want to use your money for productive things, not paying interest on spending done in the past. We know you can achieve your debt-free goals. Good luck. If you found this information helpful, please like this video and subscribe to our channel. Your support helps us out, and we appreciate it. Thanks for watching.